Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Vista Property Report. Check this place out. They use cell phone information to really track performance on your properties. It is scalable, it's customizable, it's convenient. These are property reports you want, and you can save 25% if you use the promo code CRE Show. Just visit vistapropertyreport.com/CRE Show. Well, speaking of show, we have a good one for you. Every year, we get to talk to the leaders of the CRE counselors about a report they put out each year. It's called, this year, it's the 2021 Top 10 Issues Affecting Real Estate. And the CRE counselors are an incredible group of people from around the world. To tell you how sophisticated, educated, and great these people are, they invited me to apply to be a CRE counselor and did not let me in, okay? So that's how important these guys are, but their information is great. They're a bunch of great people from industry around the world. And this report, they really take a lot of time. They interview a lot of people, and they take a lot of time to put together reports on the properties and the real estate market, forecast the economy, and really look at what are the top 10 things that you should consider moving forward when you're talking about commercial real estate. Well, please welcome my guest. It's Michel Couillard. He's with CRE Counselors. He's the global chair for 2020. He also has a day job. He's CEO of Muzak Corporation. They're an equity fund management company, and they have mixed-use property, office properties, some retail properties, some industrial. They control properties in New York and Canada and other places. They also work in the public-private partnership area. Michel, thank you for joining us, sir.
Glad to be here, Michael.
Well, great. Well, I guess the elephant in the room when we talk about the top 10 issues affecting commercial real estate is COVID, right? So that obviously is number one. So what do you think?
Well, that's what it is. In order to ramp up to number one, I guess we have a series of issues that are interrelated, and we'll get you to number one. But obviously, every issue this year will have an impact, I guess, be affected by the COVID situation.
Yeah, and then number two, you guys have economic renewal, and and as we look to COVID, a lot of people are trying to figure out, what does the recovery look like? When is it? What's happening? So tell us about number two, economic renewal.
So we're going to start with 1, 2, and going down to 10.
There you go.
Okay, all right, Mike.
Would you rather go 10 to 1? We can do it David Letterman style.
We can do it that way. But your number two quickly definitely has an impact on the duration of the situation we're all living now. A lot of uncertainties still out there. Some questions unanswered. Will there be a second wave? All these questions, I guess, and answers will have an impact on our renewal in terms of the economy recovery.
And when you guys talk about it, when you guys are at your round table and you're doing these interviews, as of today, really, what's the consensus on timing, and how do you know?
Well, the consensus, I think, and I don't know if we can talk consensus, but I guess the line of thoughts, and generally speaking, is we're right in the middle of it now. We're trying to reopen the economy in certain areas. Globally, it's been open in certain countries and certain continents. Others are right into it, and they've started to close up. And even China now is coming back into it, and they're talking of a second wave, big maybe, but I guess still remains to be seen. On the World Health Organization standpoint, they're a little cautious about reopening up the economy in general, and businesses and workplace, and the way we used to live. I think they're still prone for confinement, and I think that we'll see in the next weeks, next months, how things will evolve. In terms of our recovery, I mean, it's very much intertwined, and the obviously it's been a shutdown, a dramatic shutdown out of a sudden in March. And if you remember last year, we were at the end of the cycle. We were talking about, there were signs that are out there, and confidence was getting a little weaker in the markets in general, but on the real estate scene as well. And but we never thought we would have a sudden shutdown that we did in March. So now we have basically not only the economy, but our lives in general has been basically put on a standstill. And now we have to find a way to come back. And it's going to start by getting people back to being employed. There's a drastic level of unemployment right now, not just in America, but throughout the world. And people have to find back their jobs, back their confidence, behaviors, the way that they used to consume. But things will be a little different, and could be a lot different as we come back from that recovery. And this is the way we basically see in Q3, Q4. We'll start really starting, hopefully, unless we have a second wave, more opening up in terms of our businesses. People will be back to work more so than what we're seeing now. Right now, we're in the middle of the summer, so I think the recovery and people opening up is basically more slowly to start up again. As far as the 2020 situation, I think we're going to be seeing overall in 2020 a GDP of probably -6.1. That's basically our projection. But in terms of 2021, we'll probably see a growth of about positive 4% growth. But that will probably bring us to just over in the positive bracket for our GDP, and hopefully we'll go from there. Some economists actually has predicted a recovery of about over the next decade, 2020, and for the 2020 decade, a growth of about 1.5 to 1.6, which would be substantially less than what we've been knowing for the last 7-8 years. I'm personally, it's right now very difficult to predict anything, especially when you're talking about a decade. So I think a lot of events, a lot of parameters can happen throughout the decade, and things can change. To me, we can even aim higher than that in terms of our GDP growth. But it'll take a while. Some sectors are in terms of real estate are hurting quite a bit, and they'll take a couple of years to recover, 18 months, 24 months, and beyond. I'm talking hospitality. I'm talking retail that already is suffering prior to the COVID crisis, and then there's other sectors that actually will rebound quite nicely. Yeah. And won't be hurting as much. I'm talking about the logistic and the light industrial in certain areas of businesses, office, even the office components or the office sector will probably on a short-term basis have its adjustments. Not just probably, I'm sure we'll have its adjustment, and we have to start adjusting now. Demand and supply will be affected as well. We're starting to see signs of it. But generally speaking, I think it'll bounce back in the next 12 months, start bouncing back. We may see overall more so a W type of recovery as opposed to just a swoosh, Nike swoosh recovery like some predicted. We believe there's probably going to be some adjustment along the way in the next few months. It might be a second wave. So in some sectors, it's going to hold us back. And obviously, unemployment is fairly high. I mean, close to 15% right now. I mean, it went down a little bit in June, probably by 100 points due to the fact that we've opened up the economy a little bit, but it's still up there, and it's going to take a while to stabilize, and that's what we need to do, to stabilize all these factors in order to start seeing a decent recovery.
How are the cities looking today as we tape this here on June 30th? How are the cities looking in Canada right now related to opening back up?
Well, the major cities in Canada are very similar to what's going on in the States right now. The similar sectors, or some sectors, are suffering more than others. Obviously, Canada has been quite quick to react in terms of taking their measures and isolation procedures and protocols, and shutting down basically a lot of sectors of activity. I mean, it's been difficult as well in major cities in Canada with the employment. Some people lost their employment on a temporary basis, but quite a few lost it also permanently. And so they have to reestablish their employment first, and then we'll see how things bounce back. You're talking more Toronto, Montreal, Vancouver, Calgary. Calgary was very affected already by the natural resources and our oil and gas economy. So I guess the situation didn't help. But Montreal, Toronto, and Vancouver, in terms of supply and offer, we weren't disbalanced or anything of the kind. Office market and even urban retail situation within the city, we're in pretty good shape. So I think we're going to bounce back pretty nicely. But like I said, retail will take much longer than office. Multifamily and even residential on the condo side. I think these, now it's a question of, okay, where are the values, how that's going to take place, in the sense how the market is going to react in terms of the residential and the demand. Mm-hmm. I think the fact there's so much unemployment, I think will have obviously a direct impact on the demand of homes and even multifamily and rentals.
Yeah. Well, let's get to number 3 in your top 10 CRE counselors list here. It's capital market risk. Tell us about that.
Well, capital market risk, right now, we're seeing a low liquidity and a wait and see attitude, as I was mentioning. And right now, there's a great difficulty and uncertainty in pricing that risk. And if you remember last year, it was the opposite. We had great liquidity. Even the parameters to underwrite the deals, as much on the debt side than on the equity side, we're even getting a little sloppy in terms of the underwriting. And we were seeing signs, I guess, of reaching a bit of the end of a cycle. And now we're completely the opposite, in the sense that the liquidity has stopped. It's a great difficulty right now, as I said, to understand where the pricing is and the valuations are. If you look at the debt market, there's term defaults starting to come in. People can't pay debt service. Corporations have problems with it. They have to deal, either they pay the interest, but they can't pay the principal, or they try to negotiate something with their lenders. You're seeing maturity defaults from valuation, liquidity, cash flow shortfalls. It's very difficult to underwrite value. And with interest rates at zero, risk of valuation are very subjective and unclear. Spreads are hard to establish. And for the few transactions going on, spreads are basically, there's a floor. And that's how the deals are structured. And on the CMBS loan, I mean, there's crazy numbers right now. The CMBS loan side, there's record high delinquencies. I think in June, the plus 60 days delinquency was up at 8.7%. And the commercial debt rates were down more than 36%, and some of them more than 50%. On the equity side, well, obviously you can imagine there's a lot of limited trading on properties, and seem to focus a lot on multifamily and industrial sectors. I guess the two sectors that are behaving pretty good. And then Q3, Q4, we'll start seeing distressed properties block sales. We're actually starting to see probably some being structured right now. Like I said, in equity as well, as much as the debt side, there's difficulty in evaluation in the pricing and location and market outlook and sector types and asset class are key parameters. And then finally, for I guess in equity, there's the famous opportunistic dry powder availabilities are high. Right now in June, we were at 208 billion. I think was actually identified for value add opportunities. So that's interesting to see. So thinking ahead, I guess, with an absence of vaccine and a possible second wave coming up, the capital markets will continue to try to evaluate risk and returns the best they can.
Yeah. All right, well, let's go on to number 4. It's kind of the debt load out there on people. It's called, you guys call it public and private indebtedness.
Yep.
Tell us about that.
Well, real estate is really where it happens is really at the local scene, municipalities and then cities and townships and the value, the demand in commercial real estate can be influenced by local indebtedness, I guess, funded by local taxes. And the public debt needs to be more translated locally to understand really the interconnection with of air travels, let's say, porous logistic infrastructure and public transportation that will influence that real estate demand and values and investment activity. So on the public side, the U.S. national debt really now is at 26 trillion. That was actually up by 3 trillion from last year. Actually more than 3 trillion. Just 6 months ago, we were at just a little more than 23 trillion. Obviously, all these stimulus program is bringing up that national debt. But I think, Michael, you have to really consider comparing this with the percentage of your GDP. And the United States, America, is a deep economy. And we're at more or less 122, 121.5, 122% of our GDP, when our GDP is actually not performing like now, but let's say we would be performing in the 1.5, 1.6% area. So so the 122% is basically compares very well with other nations, and I think it can bounce back rather nicely if our economy starts rolling again. Like I said, it might take a couple of years to get going, but I think we'll be able to manage. But what's actually disturbing is more on the personal indebtedness. But just to give you an idea, also on the state side, the state debt is 1.2 trillion, but on the local debt, the municipalities where the real estate actually has a play, we're at 2.1 trillion, and that's almost double what the state debt is. On the private side, on the personal side, well, you're looking at student loan debts now are approaching 1.7 trillion. That's a big increase. Even from a year ago, it's over 300 billion increase just in student debt. And the credit cards now are up to about 1 trillion. Obviously, this will affect on individual housing investments and consumption behavior, and obviously impacting retail, auto purchase, and leisure spending for travel, and then the total personal debt exceeds now 20.5 trillion. It's another big number. And again, this will impact commercial real estate in many ways, reducing demand for housing and restraining consumption, entertainment activity. Interest rate even might go up to attract capital to fund the debt, and the ability to repair and upgrade our aging infrastructure. And it has a major impact, obviously. And so that with the unemployment so high right now, obviously it's not going to help.
Yeah. Well, let's get to number 5, and that's affordable housing made the list again this year.
Yeah, affordable housing is one of our biggest problems facing the U.S. housing market, and it's not just the U.S., Michael. We have the same in Canada, and it's a global issue. But when you think of it, poverty really is a real culprit here, and there's 3 basic needs for people, really. You have food, you got your education, hopefully leading to careers and jobs. And then there's affordable homes. People need a home. So in these times, I guess, of political divisiveness, and there's 2 things that we can all agree on, and it's the tremendous need, I guess, for this affordable housing, but also a strong NIMBY, or not in my backyard, agenda. And that's what we have. And we seem to have this issue every year, and it's not going to go away in a year. And right now, the shortage of affordable rental homes is somewhere around 7.6 million. For extremely low income renters, it's huge. It's that people being at or below poverty levels, and what you have is the lack of housing supply drives up rent, thus increasing price as well for multifamily investment properties. So, and then when you look at home prices for the bottom 20% or the 20 percentile, there was an increase of 126%, I believe. And for the homes with that top 20%, their increase was 87% over the last 20 years. So it's a no-win situation. So, you know, there's solution out there, and then there's a few solutions I guess we talked about in our narratives and in our presentation. One, I don't know if you want to go there, Mike. But I can go down the list a little bit. But
give me the top solution, the number 1 solution.
Well, you know what? The relationship between the private and the public sector is key into this, and especially the public sector towards the private sector. I think the answer is there. Yeah, we have to get more of the private sector involved with this, and expediting the approval process into any development by adding inherently beneficial use, like some state has done, to municipal land use laws to circumvent the bypass opposition, the NIMBY opposition, probably is a solution. There's always a risk to that. The other one is to expand the subsidy programs to affordable housing, to encourage the expansion of existing subsidy programs. The use of power of zoning to create subsidies as well, necessary to provide more affordable housing and market rate housing. This is another way. But basically at the local and municipal level, the use of zoning-based incentives like density, height, tax abatement, provide free land even, eliminate costly parking requirements, permits, you know, utilities, utility connecting fees, all sorts of ways here and there that can make it attractive for the developers and for the private sector to get involved into the productions of affordable housing, social housing, and workforce housing.
Yeah.
In some parts of the world, in Europe, and we have that in Canada a bit, there's a bit of a tendency towards a certain type of regulation. In some areas, they call it the 2020 regulation. Basically, it's on major development, there's a 20% going to affordable housing and 20% going to more social housing within a project. So the developer basically trades off against more flexible zoning again, restriction, excess land. He gets probably more land or other properties being also contributed by the public sector to enhance for him to develop that 20% of social housing and 20% of affordable housing in its project. And also expedite the approval and process and the permit deliveries. Or the developer has the choice to forego and to pay that special tax instead of compensating to include affordable housing components. So in other words, either he puts it in his project and then he designs the project in order to accommodate this 20% of social housing and 20% affordable, or he forgoes and he has to pay that tax. Now, that tax would allow the public to use those funds as subsidies for affordable or social housing elsewhere. But the thing is that developer or the development project has that extra zoning flexibility and setbacks and heights and density that can command the project, and he's able to pay that tax.
Yeah.
So there's an incentive, in other words, for the private sector and the public to
sure. I mean, and those are some great ideas, and there's some land out there, and especially in the opportunity zones. And like you said, if you cut back on some of these costs for all the entitlement and construction and the hookups, and there's a lot of ways to help tackle affordable housing. Well, that's the top 5. We have 6 through 10 coming up. We're going to take a quick break. We'll get right back, and we'll look at the CRE counselors' top 6 through 10 issues affecting real estate. Stay with us. I'm Michael Bull. We'll be right back. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, CREshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.